Okay, good day. Once again, I'm Teacher Lei, and now we're going to discuss Excess MCIT Carry-Forward, Quarterly Tax on Corporations, and Improperly Accumulated Earnings Tax. We have discussed the income tax rules under corporate income taxation in our previous video, but it is worth mentioning them again here. For domestic corporations operating for 3 years or less, the income tax will be based on normal tax equivalent to 30% of taxable income. However, starting on the 4th year of operation, a domestic corporation's income tax will be based on normal tax of 30% based on taxable income, or the minimum corporate income tax of 2% based on gross income, whichever is higher. For example, a domestic corporation has the following computed minimum corporate income tax and normal tax for year 4 to year 8. Based on the given data, we can say that the computed minimum corporate income tax for years 4, 5, and 7 are higher than the normal income tax for those years. While for year 6 and year 8, normal tax is higher than the minimum corporate income tax. Should the minimum corporate income tax be higher than the normal tax, then the year's tax should be the minimum corporate income tax. In our example, since minimum corporate income tax of 80,000 is higher than the normal tax of 20,000 in year 4, the year's tax is MCIT of 80,000. Same with year 5. Again, minimum corporate income tax of 50,000 is higher than the normal tax of 30,000. Therefore, the year's tax is 50,000. Let me introduce to you the concept of excess MCIT. Excess MCIT occurs when the computed minimum corporate income tax is higher than the normal tax. This is the difference between the minimum corporate income tax and the normal tax computed for a given taxable year. For year 4, excess MCIT amounts to 60,000, which is the difference of 80,000 MCIT and 20,000 normal tax. And for year 5, excess MCIT amounts to 20,000, which is the difference between MCIT of 50,000 and normal tax of 30,000. This excess MCIT over the normal tax can be carried forward and credited against the normal tax for the 3 immediately succeeding taxable years. Thus, the excess MCIT for year 4 can be used until year 7, and the excess MCIT in year 5 can be used until year 8. In the year to which carried forward, the normal tax should be higher than the minimum corporate income tax of the year. In year 6, normal tax of 40,000 is higher than the minimum corporate income tax of 30,000. Since normal tax is 40,000 and the excess MCIT in year 4 is 60,000, we can credit 40,000 of it and deduct it in year 6. Thus, the year's tax for year 6 will be 0. That is normal tax of 40,000 less the excess MCIT from year 4 of 40,000. Take note that we can only deduct up to the maximum amount of normal tax to be paid, which is 40,000, and not the whole 60,000. In year 7, MCIT of 40,000 is again higher than the normal tax of 20,000. Thus, whenever the MCIT is higher than the normal tax, always the year's tax will be the MCIT. In this case, year's tax will be 40,000. Excess MCIT for year 7 amounts to 20,000, which is the difference between MCIT of 40,000 and normal tax of 20,000. Remember that excess MCIT only occurs when MCIT is higher than the normal tax. This excess MCIT of 20,000 in year 7 can be used in the next 3 years or until year 10, when the normal tax for the year is higher than the MCIT. Let's go to year 8. In year 8, the normal tax of 70,000 is higher than the MCIT of 35,000. When normal tax is higher than MCIT, we should look if there can be credited as excess MCIT from the last 3 years. Remember that we have already used 40,000 of the excess MCIT of 60,000 in year 4. However, the remaining 20,000 excess MCIT in year 4 has already expired in year 7 and can no longer be used in year 8. In year 5, there is an excess MCIT of 20,000, and this can be used until year 8. Also, an excess MCIT of 20,000 in year 7 can be used in year 8. Thus, after deducting the excess MCIT, the year's tax for year 8 will be 30,000. That is 70,000 less 20,000 excess MCIT in year 5 and 20,000 excess MCIT in year 7. That is how we compute for the excess MCIT carry forward. For our next lesson, we are going to discuss quarterly tax on corporations. Domestic corporations file quarterly and annual income tax returns. Within 60 days after the end of each of the first 3 quarters of the year, a corporation files an income tax return, that is for the first quarter up to the 3rd quarter, through the 1702Q form. On or before the 15th day of the 4th month following the close of the taxable year, a final or annual income tax return is filed through the 1702 regular tax form. The quarterly and final tax returns are summary declarations of gross income and deductions on a cumulative basis. Deductions may be the itemized deduction for expenses and losses or the optional standard deduction consistently from the first quarter. The normal income tax and the minimum corporate income tax are computed on the quarterly and annual income tax returns starting the 4th year of operations, and whichever is higher between the normal income tax and the minimum corporate income tax will be paid. The tax computed on the quarterly or annual income tax returns is decreased by the amount of tax paid for the preceding quarter or quarters. There may be an income tax payable but not refundable in a quarterly return. Passive income with final tax paid and capital gain with capital gains tax are not included in the quarterly and annual income tax returns. If the sum of the quarterly tax payments made during the year is not equal to the tax due on the final return, the corporation may have an income tax still due, a carryover, or income tax refundable. Let's have an illustration. Andre Company, a domestic corporation in its fourth year of operation in 2019, had the following cumulative balances at the end of each quarter and at the end of the year. In the problem, there are different items of income and expenses, but please remember that only those incomes subject to the corporate income tax scheme will be included in the quarterly and annual income tax returns. Passive income with final tax and capital gain with capital gains tax are not included in the quarterly and annual income tax returns. The first thing we need to do is to classify these items as to what income taxation schemes they will fall. For gross profit from sales, this is an active income of domestic corporation and thus will be subject to corporate income taxation. Interest on Philippine currency deposit is a passive income subject to final tax. Capital gains on sale directly to buyers of land in Pasig held as capital asset is subject to capital gains taxation. Capital gain on sale of shares of stocks of a domestic corporation not listed in the Philippine Stock Exchange and held as capital asset is subject to capital gains taxation. Dividend from domestic corporation is a passive income subject to final income taxation. Business expenses are allowable deductions under corporate income taxation. After classifying the items of income and expenses, we have determined that only the gross profit from sales and the business expenses will be included in the preparation of the quarterly and annual income tax returns of Andre Company. Since Andre Company is already in its fourth year of operation, we will be comparing for the normal income tax of 30% based on taxable income and minimum corporate income tax based on 2% of gross income. First, let's compute for the taxable income and the normal tax in each of the quarters and for the whole year. For the first quarter, 350,000 gross profit from sales less business expenses of 200,000 equals taxable income of 150,000. Normal tax of 30% based on taxable income of 150,000 will be 45,000. That is 150,000 times 30%. For the second quarter, taxable income is 220,000. That is 530,000 less 310,000. And the normal tax is 66,000. That is 220,000 times 30%. For the third quarter, 790,000 less 380,000 is equal to taxable income of 410,000. 30% of which is the normal income tax of 123,000. For the year, taxable income is 995,000 less 490,000 is equal to taxable income of 505,000. Normal tax of 30% is 151,500. After computing the normal tax of 30% based on taxable income, let us now compute for the minimum corporate income tax of 2% based on gross income. For the first quarter, 2% of gross income of 350,000 is equal to 7,000. For the second quarter, MCIT is equal to 2% of 530,000, which is 10,600. For the third quarter, 790,000 times 2% is equal to the MCIT of 15,800. And for the annual income tax return, MCIT is 995,000 times 2%, which is equal to 19,900. After computing the normal income tax and the minimum corporate income tax for the quarterly income tax returns and annual income tax returns, let us now determine which is higher in each of the quarterly and annual income tax returns. For the first quarter, the normal tax of 45,000 is higher. For the second quarter, again, the normal tax of 66,000 is higher. For the third quarter, normal tax of 123,000 is higher than the MCIT. And for the annual income tax return, normal tax of 151,500 is higher than the MCIT of 19,900. The tax computed on the quarterly or annual income tax returns is decreased by the amount of tax paid for the preceding quarter or quarters. There may be an income tax payable but not refundable in a quarterly return. In the first quarter, since it is the first quarterly income tax return of the year, whichever is higher between MCIT and normal tax will be the income tax due or payable. In our case, 45,000 is due. For the second quarter, we will be deducting the income tax payment in the first quarter of 45,000 from 66,000. Thus, the income tax is still due for the second quarter will be 66,000 minus 45,000 or 21,000. For the third quarter, we will be deducting the quarterly income tax payments from the first quarter of 45,000 and the second quarter of 21,000. Thus, the income tax is still due for the third quarter is 123,000 minus 45,000 minus 21,000 is equal to 57,000. For the annual income tax return, we will be deducting from 151,500 the tax payments for the first quarters of 45,000, second quarter of 21,000, and third quarter of 57,000. Thus, there is still an income tax still due of 28,500. That is how to compute for the quarterly and annual income tax returns of a domestic corporation. Let's go to our next topic, which is the improperly accumulated earnings tax. The improperly accumulated earnings tax is imposed on a corporation that is a closely held corporation or a corporation that accumulates profits beyond the reasonable needs of the business. A domestic corporation classified as a closely held corporation must file an improperly accumulated earnings tax return or BIR Form 1704 and pay the tax within 15 days after the close of the year succeeding the year of improper accumulation. For example, the IAET return for the calendar year 2018 improper accumulation should be filed on or before January 15, 2020. Closely held corporations are those corporations controlled by not more than 20 individuals or at least 50% in value of the outstanding capital stock or at least 50% of the total combined voting power of all classes of stock entitled to vote. is owned directly or indirectly by or for not more than 20 individuals. The improperly accumulated earnings tax is 10% of the improperly accumulated taxable income. The formula is as follows. Taxable income plus income subject to final tax plus net operating loss carryover plus income excluded from gross income plus income exempt from tax, and get the total, less income taxes paid, deduct also dividends declared or paid, and get the total. Then we add retained earnings from prior years to get the accumulated earnings. Then we deduct amount that may be retained. According to Revenue Regulation Number 2, accumulation of profits is proper if it is needed for additional working capital, expansion or improvements and repairs, debt retirement, acquisition of related business, or the purchase of a stock of related business where a subsidiary relationship is established, and anticipated losses or reverses to business. BIR Form 1704 amounts reserved for the reasonable needs of the business would include reserve for definite corporate expansion projects and programs, reserve for building, plant, and equipment acquisitions, reserve for compliance with any loan covenant or pre-existing obligations established under a legitimate business agreement, and earnings with legal prohibition against distribution. Those are the amount that may be retained. After deducting the amount that may be retained, you will arrive at the improperly accumulated taxable income and multiply it by 10% to get improperly accumulated earnings tax. Let's have illustration. ABC Company, a domestic closely held corporation, in its 10th year of operations in 2018 had a net taxable income with no capital gains tax and no passive income with final tax of 1 million pesos, which is also the net income for the year in the income statement prepared by the accountant from the books of accounts. Retained earnings at the beginning of the year was 4 million, and the paid-up capital as at the end of the year was 2 million. It never distributed profits to its stockholders. If the Bureau of Internal Revenue makes a finding that the accumulation of profits is improper, how much is the improperly accumulated earnings tax? Based on our formula, taxable income is 1 million. Then let's add income subject to final tax. According to the problem, there is no passive income with final tax, so our answer is 0. Then we add net operating loss carryover. Again, the problem did not specify any net operating loss carryover, so 0. Then we add income excluded from gross income. The problem also did not specify income excluded from gross income, so 0. Then we add income exempt from tax. There is no income exempt from tax, so 0. Then we total. So 1 million. Less income taxes paid. Remember that we have taxable income of 1 million, and domestic corporations are subject to 30% income tax. So therefore, the income tax paid is 300,000. That is 1 million times 30%. Next is to deduct dividends declared or paid. According to the problem, It never distributed profits to its stockholders, so there were no dividends that were distributed, so zero. So we deduct 300,000 from 1 million, that is 700,000. Then we add retained earnings from prior years. According to the problem, retained earnings at the beginning of the year was 4 million. So total accumulated earnings therefore is 4,700,000. Then we deduct amount that may be retained. According to the problem, the paid up capital at the end of the year was 2 million. This is an allowable amount that may be retained by the domestic corporation. So 2 million. Deduct that from 4,700,000 to get the improperly accumulated taxable income of 2,700,000. Then we multiply it with the IAET tax rate of 10% to get the improperly accumulated earnings tax of 270,000. That is how to compute for the improperly accumulated earnings tax. And that ends the Chapter 3, or Tax on Domestic Corporation. Should you have any question, you may send them to my messenger account. Thank you and God bless.